We're live.
We are live.
Oh, great. Excellent. Hazel, do you want to?
Good afternoon. We are now starting our webinar on some tax tips which may be useful to you. I think we'll just wait a few minutes to see if some more latecomers will straggle in.
Yeah, and we've got a special guest today, Rob Evans. We'll just, as Hazel said, we'll wait for a few seconds and we'll do some introductions and before we start. Right, for those that have just joined, with respect, well, maybe minutes more for people to join, and then we'll make it. Okay, well, let's make a start. First of all, my name is Jamal Khan. I'm a senior tax partner at the firm, and we've got Hazel Johnson, who's a tax director at Churchill Tax. We've got Usama, who's a senior tax advisor. He's done a couple of presentations with me in the past, so a lot of people would have seen him, and Usama's one of our top technical people. We've got a special guest, Robert Evans, who deals with the properties in the UK for offshore investors. Rob will have a few moments to speak about himself, about what he does. Very interesting and very good contact to have. Once Hazel and Osama have completed their presentation. And today our topic is very, very important, and in fact I got asked a question about it yesterday as well, is about different tax reliefs that apply to properties for onshore, offshore investors. And there are reliefs that are misunderstood or misinterpreted. One of them being somebody asked, one of the forums that I'm on, somebody asked a question. Somebody sold a residential property and is buying another residential property. And can they defer they roll over the capital gains tax? So this was, it's a common question. It actually came from an accountant, this question. It's very, very important that this part is fully understood. And I will hand over to Hazel and Sama, who have prepared the presentation, who are actually the brains behind the firm, and I'm heavily reliant on them for the technical input. Over to Hazel and Sama.
Okay. I will share my screen with you. Okay, so this is a seminar that's going to talk to you about tax saving tips. We are.
Sorry, Hazel. For me,
Yeah.
it's coming as if our photos are coming on top of the old image is coming on top of the shared screen. So the shared screen can't be seen properly. I don't know if the other hosts can. Osama, did you have the same?
Yeah, it was the same.
Okay,
Yeah.
but I'll try this version. Oh, that doesn't make it any better, does it?
Nothing.
How about that? Is that better?
If we go on top middle of left-hand side, well, I have a blank screen now.
I guess the problem you're having, Hazel, is because you can't see. You can only see the slide. You can't see what. This is the problem I have.
Yes.
If you try one more time, if it doesn't, but anyway, it's fine. We try one more time. If it doesn't, then we just continue as it is.
No, it doesn't like it today. Okay, well, I will talk about it, and we can circulate the slides to anybody who's interested afterwards.
If we bring up the slides as it was, and then we can. That's never happened before.
No, I don't know what it's doing today. Try that.
You did what you did the first time.
None of it is working this time. I'm doing exactly what I did before, and it's not liking it at all.
Do I need to try it?
Yeah. No, it's just not working for me.
Can you try and share, please?
Let's see if this one works. Is it working?
Well, we've got tax saving tips. We've got back to the old version that we didn't like.
Because I can't see myself or any of you though. So.
What we've got is the slides with 4 pictures on top of it. I think that's the best we can do today. I don't know why it's not working as usual.
Right. Okay. Well, let's carry on. Hazel, you've got the slide with you, and then let's just move on. It was just.
So, as I was saying, Churchill Tax Advisors, we are a specialist tax advisory firm based in London and Essex, but we offer national coverage, and we specialise in tax planning, including income and business tax and inheritance tax. We also do tax investigations, dispute resolution and tax tribunals, and all sorts of complex investigation work, including disclosure of undeclared income. So what we're going to talk about today is top tax tips, and we're going to talk about holdover relief, rollover relief, incorporation relief, and business property relief. So I'm going to talk about holdover relief. So they apply on the transfer of business assets. So normally, if you transfer an asset to someone, either by way of a gift, then what's not commonly appreciated is that you have to pay capital gains tax on that transfer. and the revenue will assume that you have received proceeds equal to the current market value of the asset. And obviously, this is a bit of a hindrance for passing on business assets down through the family or to other people you want to benefit. So where you have a business asset or you have company shares which qualify, what you can do is make a transfer to another individual, and the capital gain is calculated, but deducted from the value of the shares or the business asset in the hands of the recipient, so that you don't have to pay capital gains tax, and your capital gains tax bill is handed on to the person who received either the shares or the asset. In the case of business assets, they have to be assets that are used in a trade. And in the case of shares, it must be an unlisted company, and it must be what we call your personal company, where you've got more than 5% of the shares or the voting rights. And the company itself must be trading. So it's got to be providing goods or services, but not things like holding investments. And you use that relief to transfer property development company shares, but it won't apply to property investment companies.
Sorry, Hazel, just before you move on, can you guys see that I've moved the video picture images to the right thumbnail?
Yep.
Okay, so it's not covering the screen anymore for everybody. Okay, carry on, please.
So I've finished talking about holdover relief, and Osama's now going to talk about rollover.
So basically, a lot of individual clients and accountants alike seem to get confused with the concept of rollover relief and when it's actually applicable. It's only applied to businesses. You cannot apply it to properties. When you buy a new asset, or you use it in your business and you sell it, revenue gives you a favor in terms of you can roll over the CGT, the capital gains, into the new acquired property or acquired sort of business asset. Now the rules are if you do it within 3 years, you can claim the relief. If you acquire it before selling the old asset, it's 1 year before and 3 years after. The business must be a trading business. This is the key. It has to be a trading business, not the investment. When you sell the old assets, buy the new ones, you can transfer the CGT, effectively reducing the base cost of the new asset, allowing you not to pay any tax on the previous sale. Applies to land and buildings, again, trading, plant and machinery, and goodwill. The claim must be made within 4-year period from the end of the tax year where you've sold the asset. It is key. Usually done through a tax return. If you're individual or corporate tax return, you have to inform HMRC that you've sold this previous asset and now you've bought this new one effectively, and what the implications are. So HMRC is fully aware. That's a small one. Over to you for incorporation, Hazel.
So incorporation relief is something that applies when you have been running a business as a sole trader. You can include a property business in this where you've got a business partnership, but not if you're sort of holding assets jointly. So if you have a husband and wife who are holding properties together, that's not going to be enough to qualify for incorporation relief. And essentially what you do is you transfer the business and all of its assets except cash in return for shares in the company. Now, again, normally there would be a capital gains tax charge if you didn't claim incorporation relief on the value of the assets transferred to the company. And then the company would take on those assets at their then market value. But when you claim incorporation relief, that capital gain is not triggered. And effectively the base cost of the assets are reduced. So if you transfer your business in return for shares worth £100,000, and you would normally be making a capital gain of 60,000, when you later come to sell the shares and need to work out the capital gain on that, then their cost for capital gains tax calculations is going to be 40,000, which is the 100,000 less the 60,000 gain that has been rolled into the shares by incorporation relief. So this can be very valuable as an opportunity to incorporate a business without triggering capital gains tax charges, if that's the appropriate vehicle for you to be conducting your business going forward. Business property relief is an inheritance tax relief, and it applies where you have got a trading business. So this is not going to apply to landlords who have, again, it's an investment business. And to qualify for it, over 50% of the trade has to be devoted to the business. And you can look at that on a basis of turnover, time spent in the business, or profits generated by the business. And it sort of tends to be what we call an elephant test. You will know if you see one, whether you've got a trading business. Because sometimes turnover may be predominantly investment based, but the profits may be more trading related. So it's not the case that those three things will always be all above 50%. And it's just enough, if you look at the business overall, that 50% is devoted to the trade. One thing to be aware of is that for the purposes of this relief, a cash balance is counted as an investment asset unless it's being held for the purposes of the trade. So if you're holding a cash balance to invest in something, you need to be documenting that, so that if HMRC asks you what that cash mountain is for, then you can demonstrate that you have been holding it for trading purposes. If you have investment assets in the company, but you still have 50% devoted to the trade, what happens is you get 100% business property relief, but the amount on which you are given that 100% relief is reduced by what we call accepted assets. So you get 100% relief, say, on 70% of the value of the company, which is, a silly way of going about things, but that is the way that the calculation is done. So as I say, it's important when you're looking at business property relief that you are documenting decisions so that any cash balances are being clearly held for trading purposes, and that you are able to show that you're devoting the necessary amount of time in the business to generate trading profits. We have the next slide, Osama. So in summary, if you have got a trading business, say you're a property developer, you can look at claiming holdover and rollover relief, and business property relief may be available on the value of the shares in your estate. But if you've got an investment business, say you're a landlord, then these reliefs are not going to apply, and you're going to need to consider different planning techniques. And those are our details and our pictures, so you can remember what we look like. And as I say, we do these webinars sort of monthly, so you can have tax planning and tax updates, and you can subscribe to our YouTube channel and join our live webinars.
Thank you, Hazel. Thank you, Osama. It's very useful. The only thing that's missing from the slides is Osama's mugshot. And I think, otherwise, thank you, Osama and Hazel. That's very, very good. Can I pass over to our special guest, Rob Evans? Rob, do you want to tell us about yourself? Tell us about what you do and how you can help some of our clients who are high net worth individuals. Tell us about yourself.
Good afternoon, all attendees, and thank you to the hosts. I identified with some of the issues that Hazel raised there. Personally, as I have a couple of scenarios myself, which are not dissimilar to ones described. So some very sound advice from Hazel.
I'm sorry, Rob. Your picture seems to be frozen. Hazel, is Rob's picture frozen for you, or is it just for me?
It's frozen for me
Rob,
as well.
put the camera off and put the camera back on. We might be able to see you.
Just a moment. Bear with me.
I think Storm Francis is causing a lot of trouble today.
We can survive this. We'll survive anything. I mean, I think we're having a little problem with the camera. I hope, with the internet. So should I just continue rather than... I have a face for radio anyway, so it's no hardship. We'll keep trying with the camera. I'm probably frozen in some, delightful pose, so it'll be marvelous. Moving on, I think in essence, what you guys do is you allow people who are in a fortunate position to be able to invest in real estate. I mean, my business is focused on London, and your business is one of assisting clients in retaining gains and profits that they've made through their activities. Obviously, you don't just deal in property; you have a broad practice. Our business, we're not an estate agent. We are a property advisor, and we work for our clients, effectively making them more money. In essence, we work on the residential rental side of the business. On average, our clients made something like 9.3% net rental income more. Money in the bank. That's not a notional figure. And we work with predominantly about 80% Middle Eastern families. 100% of our business comes through referral from trustees, banks, tax advisors, and lawyers who are the trusted advisors of these families and individuals. And they come to us because they want to benefit from a better return on those assets. And so on the one side of the coin, we're helping them make more money out of the given asset. And on the other side of the coin, you guys are there to make sure that money made is with them, through ultimate means, obviously. In terms of the other aspects of our business, so we work in acquisition, we work in investment, asset management, so rental properties. We manage clients' private residences, and we also do a provider managed sale. We don't work on any commission. We believe commission has a potential for conflict of interest in the sort of advice we give, which is long-term relationships, and we have no lock-in for our clients. We have a simple 30-day notice. So we present it to clients who have, underperforming assets. The 9.23% net rental income gain that we look at average on last year doesn't include rental increases. That's an addition to that. That's just employing our strategic approach to the asset management. The benefit, of course, the miracle of compound interest means that if you're making incremental, you can deal with things like amortizing your loans and this and that and the other. And we provide under our umbrella a full discretionary managed service for clients' own assets. They don't need to be they're obviously not under our ownership in any structure. They're in whatever structure the client currently holds them, which could be a trust, it could be a company, it could be an offshore company, could be in their private names, or names of children, or etc. So we work, as I say, mainly for single-family offices. We represent currently something like 38 single-family offices who have a range of assets in the UK. We are 100% London-based, and our assets are within London. So we're making them more money, and hopefully you're helping them hang on to that extra few few pounds, which make the investment work. I don't know whether that's comprehensive enough for you.
That's fine. So
Hello?
Rob, thank you. Do you mainly deal
I'm
with
afraid I
family
can't hear you.
offices, or how can clients
I
approach you?
can't hear anything. I'm afraid I can't hear you if you're speaking to me. It's very faint.
Oh, am I faint for everybody?
That's better.
Right. My question was: do you mainly work with family offices, or are you? How do clients find you?
Well, 100% of our business is by referral. So it might be from their bank, it might be from their trustee or fiduciary, it might be from their law firm. It's basically, we work alongside their trusted advisor. In our service, the strategies we employ for the clients are not elitist, in the sense that we have clients, if we have a referral, we honor the referral. So we have clients who are obviously single family offices and would be well-known names in the global business community. But we also work for people. I mean, we have one situation where we have an employee of one of our family offices who has bought their first studio flat as part of their own planning, and we handle that for them as well. So we also work for sort of perhaps heart surgeons or a sort of range of people. So it's not exclusively for single family offices. That's probably the majority of our clients, because it's usually where we can demonstrate the best returns in terms of cash and performance of the asset. It works for a £400 a week property as well as a £4,000 a week property, and it's just we're sort of not exponents of the percentage gain, as it were, with regards to real estate, which we feel punishes the larger client, really. So we're a sort of brought in by their trusted advisors when they feel that they should be getting something more than what's available on the high street. And we have a way of working, we have a position in the marketplace, and I won't go into it here, but in effect, the way we structure it is sort of come from over 30 years that I've been doing residential property in central London, and just the knowledge to devising a better way of dealing with the client's assets to deliver more money to them, because it can be very costly, and when yields are 3.5%, you need to make sure you can hold on to as much of that money as possible.
Sure. Thank you very much. Now, if the audience has any questions to Osama and Hazel or to Rob, please put them in now. We've got one question. Hazel, I think Osama's answered it already, but Hazel, do you want to cover? Sorry, Osama, can you cover that for the wider audience?
Yeah, so the question was rollover relief. How much of the proceeds from the sale need to be reinvested to qualify? Now, written, the answer is, and any amount would qualify, but the rollover relief will be restricted based on the sale proceeds. So if you want the full relief, you need to reinvest the whole amount of the sale. Otherwise, it will be partly restricted. Again, this depends on how much you reinvest. There's a formula that needs to be applied.
Can you give some numbers, Osama, in terms of just a numerical example, please, just so that audience is clear?
Sure. So if you have, say, a capital gain of £50 or 50,000, whatever you want to call it, and the sale proceeds you got was 200,000 for the previous sale. Now, if you're reinvesting 200,000, then the full £50 the capital gain will be rolled over into the base cost of the new shares. or the new asset. But if you invested half, then half will be taxed straight away, and the other half will be rolled over into the cost of the new, again, asset or shares. That's how the rollover relief works. It's slightly different to holdover relief, where it's frozen. It's called frozen relief, where you've got 3 conditions. But with rollover, it's simpler, which effectively reduces the base cost of the asset going forward. So there's no time limit to it, whereas holdover relief is a time limit that applies. Again, it depends on what sort of reinvestments you're making, either in business asset, whether it's land and building, or it's a fixed plant and machinery that you're investing, or in goodwill for that matter. So you have to be careful with what you're reinvesting it, so that you can benefit in the long run.
The point that I've got another question which comes to the same, is that it has to be a business asset. I've just received a message from somebody to say, I have 15 buy-to-let. This is the message that I have 15 buy-to-let residential properties. If I sell one, will it be seen as a trade? First question. Secondly, if I sell one property, can I defer the capital gain if I buy another property?
No, if he's holding the properties as investment, then it's an investment business. Therefore, no rollover or holdover relief available. But if that's his business of buying and selling properties, then we can look into. Again, if it's just a one-off transaction, there's something called badges of trade that you need to look into in order to check what qualifies as a trade. Investment properties usually do not, unless you're a property developer, in which case, yeah, it can be looked into as holding stock or a business asset. But again, if it's just 2 individuals or 1 individual owning property and you're selling a property, there is no relief available unless you live in a property which is completely different.
Right. Okay. Does the position change for only offshore investors? That's the next question. I think the question I have is the new rules have been introduced for offshore investors for stamp duty, etc. Have you had a chance to look at that yet, or?
Well, the first thing to be said about the new rules for offshore investors, with the stamp duty land tax surcharge, which comes in sort of next year, is that the rules for residents are going to be different from the rules of residents for income tax and capital gains tax. So that the rules are still in draft at the moment, but you could face the prospect of not being resident for income tax or capital gains tax purposes, but possibly being residents for stamp duty land tax, and apparently vice versa. So the rules are still sort of being considered, and there's a consultation underway, because it doesn't really make a lot of sense to have those 2 rules being so widely different. But those that's the position currently. So if you've been taking advice on your resident status for income tax, and you know how many days you can spend in the UK and your connecting factors, those rules will probably not be the same for stamp duty land tax next year. And you could find yourself in a very different position. I suppose theoretically it might be possible to organise things so you were not resident for income tax purposes, but were resident for stamp duty land tax purposes, and so you didn't have to pay the surcharge, but weren't subject to income tax or capital gains, or all capital gains, because of course non-UK residents are now taxable on capital gains on UK land, and the rules on that are very complicated, and they vary depending on whether you're holding it through a company or personally, but at least some portion of the gain will be brought into charge either as of 2015 or as of 2019. And the rules on that are very, very complicated.
Excellent. Well, if you've got any more questions from the audience, I think we've answered most of the questions that we've had. Some of the other questions I think you've covered already in your presentation. I'd like to thank everybody. I'd like to thank you, Rob. Rob, do you have any contact details that you can share so people can contact you?
You're very faint again. I don't know whether you're far away from the microphone or I can barely hear you, to be honest with you.
I'm sorry. Can you hear me now?
Keep doing that. What did you say?
Can you hear me now?
Perfectly.
Okay. Do you have any contact details that you can share for our audience? Just read them out.
I've supplied those to your colleague earlier.
All right, you did. Okay, that's great.
So they should be with you somewhere.
Thank you for joining us today.
It's my pleasure. Thank you for having me.
The audience, hopefully we will send out a recording in due course. If you have any questions, you can contact Hazel or Osama. Hazel's email is h.johnson@churchill-tax-advisors, and Osama's email is Ruiz, AWIS, Osama?
AWAIS.
AWAIS@churchill-tax-advisors.co.uk. You can call us on 0207 998 1834. Thank you very much.
Thank you.
Thank you. Bye-bye.
Bye-bye.